In this series of videos, we learn the pricing, valuation, and applications of swaps. We start with what swaps are and their underlying mechanics. Then we talk about the types of swaps. In this video, we cover the pricing, valuation, and application of plain vanilla swaps only, that is interest rate swaps. Currency and equity swaps are covered in the next two videos of this series. A swap is a contract where two parties agree to exchange a series of future cash flows over a fixed time period. The cash flows may be in a single currency, such as in the case of interest rate swaps or an equity swap, or it may be in different currencies, such as in the case of currency swaps. A simple example would be an interest rate swap where one party pays fixed 8% and the counterparty pays LIBOR each quarter over 2 years. So the first party pays 8% fixed and receives LIBOR, while the counterparty pays LIBOR and receives fixed 8%. This is a fixed for floating swap. There are four types of swaps based on the underlying involved. One is an interest rate swap where the underlying is an interest rate where one party pays variable and the counterparty pays fixed or variable in the same currency. There is a notional amount of the swap, however it is not exchanged but just used to calculate the payments. In currency swap, the parties involved pay each other fixed or variable rates in two different currencies. The notional principal may or may not be exchanged. We will cover these in the second video of this series. In equity swaps, at least one party pays a return that is determined by the price of a stock, equity portfolio, or an equity index. The notional amounts are not exchanged and only used to calculate payments involved. The counterparty may pay the returns on another stock, equity portfolio, or an equity index, or even an interest rate which may be fixed or variable. We will cover these in our third video of this series. In commodity swaps, at least one party must pay the returns determined by the price of a commodity such as gold or oil. The counterparty usually pays fixed, but it can be variable rate. Like forward and future contracts, swaps don't involve any upfront cash, and this is because swaps have a zero value at the start. That is when they are initiated. Also, swaps have a notional value, and except for some currency swaps, it is never exchanged but just used for calculation of payments of the two sides. As swaps involve a series of payments over time, the day at which payments occur is called settlement date, and the period between two settlement dates is known as settlement period. There is credit risk involved in swaps as these are over-the-counter instruments. Though credit risk is zero at the start of the contract because the value of the contract is zero, it is generally highest in the middle of the swap term and reduces as it approaches the end of the swap period. Swaps are over-the-counter customized contracts and involve a swap dealer, which is a financial institution that is dealing in swaps, technically called as the market maker. The other party is the end user, which is the customer of the swap dealer. That may be a corporation, pension fund, hedge fund, or any other organization. In an interest rate swap, one party pays variable while the counterparty may pay fixed or variable. However, here we focus on plain vanilla swaps, that is where one party is paying variable and the counterparty is paying fixed. In this example here, we have XYZ entering into a plain vanilla swap with a notional value of $50 million and the counterparty is AB Swaps. The payments will be on 15th of March, 15th of June, 15th of September, and 15th of December, and the term for the swap is 1 year. And the underlying is here a LIBOR. XYZ will pay 7.5% fixed and AB Swaps will pay LIBOR. Interest is based on exact day count and 360 days, that is 30 days per month in a year. If LIBOR is higher than the fixed rate, then the fixed rate payer will receive a net payment from the counterparty. If LIBOR is less than the fixed rate, then the fixed rate payer will have to make a net payment to the counterparty. This shows the netting on the swap, which also helps reducing the credit risk in a swap. In our example from the previous slide, XYZ is paying 7.5% fixed and receiving LIBOR from the counterparty, that is AB Swaps. The notional value of the swap is 50 million and interest payments are based on actual days and a 360-day year count. In figure 11.1, the structure of the swap in our example is depicted, and we see the swap starts on the 15th of December and the first payment will be made on the 15th of March, the second payment will be made on the 15th of June, the third payment will be made on the 15th of September, and then the final payment will be made on the 15th of December next year. Now, we see that one party will pay LIBOR, which is AB Swaps, and the other party will pay fixed 7.5%, which is XYZ. Q here is actually the number of days divided by 360. The number of days here will be actual count, so for some quarters it will be 91 and for some it may be 9. Payments will be netted. So XYZ will receive or pay 50 million into LIBOR minus 7.5%, which is the fixed rate, multiplied into actual days, which may be 90 or 91, divided by 360. This may be positive or negative. So if it is positive, then XYZ will receive this, and if it is negative, then XYZ will have to pay this. Note that when the swap is initiated on the 15th of December, the parties will already know the LIBOR for the first quarter, that is the March 15th payment, because the interest rate is set in advance of the quarter. So the first quarter LIBOR will be known here, and it will be known to both the parties how much is the fixed payment and how much is the floating payment. So basically both the parties know who has to make the first net payment. However, the LIBOR here and the LIBOR here and the LIBOR here are not known. To know this, we will have to wait for 3 months, that is from 15th December to 15th March. So once we are here, then we will know the LIBOR for the second quarter. Once we are here, then we will know the LIBOR for the third quarter, and once we are here, then we will know the LIBOR for the fourth quarter. So it is important to know that the LIBOR payments will be known only when we progress through the timeline on the swap. The fixed payments are fixed and hence will be known in advance on the 15th of December. It is the payments on the LIBOR that will be determining the net payment to be either positive or negative. This also implies that we will know the net payment to be made or received on 15th March, on 15th December. Similarly, we will know the net payment to be made or received on 15th June, on the 15th of March. For the third quarter, we will know on the 15th of June what net payment will be made or received on 15th September. The same is the case for the fourth quarter. This means that gains and losses on swaps are not settled in advance, but are settled on the settlement dates for the respective settlement periods. The payoffs on the swap in our example are shown here in table 11.1 with assumed LIBOR rates on December 15, March 15, June 15 and September 15. XYZ has to pay fixed 7.5%, while AB swaps has to pay the LIBOR. As we know that LIBOR rate to be paid in a quarter is set and known at the start of the quarter, the LIBOR on 15th December is used to calculate the payment on 15th March and so on. Therefore, the payment on the floating rate side by AB swaps will be 50 million multiplied into 6.8% multiplied into 90 divided by 360. That is 50 million multiplied into 7.68% multiplied into 90 divided by 360. This will give us 960,000. The fixed rate side will have to make a payment of 937,500, which is equal to 50 million, the notional amount on the swap multiplied into the fixed rate 7.5% multiplied into the actual days 90 divided by 360 days in a year. As payments are netted on the swap, so on the 15th of March, XYZ will receive 22,500 from AB swaps as the difference between what AB swaps owes it and what it owes to AB swap. That is LIBOR minus the fixed rate payment. Similarly, on the 15th of June, LIBOR on 15th March will be used to calculate the payment on the floating rate side, and the fixed rate will be used to calculate the payment on the fixed rate side. Remember, now the number of days in the quarter are 92. As the fixed rate and the floating rate are the same on the 15th of March, so that means that both the floating rate side payment and the fixed rate side payment are the same. The result is that there will be zero net payment to XYZ. In the third quarter, we see that LIBOR is assumed to be 7.06%, which is less than the fixed rate. So in this case, when the payments are calculated for the floating rate side and the fixed rate side, XYZ has to make a net payment of $56,222 to AB swaps. Same is the case in the fourth quarter. However, the interest rates have gone to 6.06%, so XYZ has to make a large payment of $182,000 on the swap to AB swaps. Remember, we assumed these rates here. You can change and assume your own rates and use them to calculate the payoffs here. Now, the question is, how do we know that the fixed rate payer must pay 7.5%? That is, how is the fixed rate determined? Again, the guiding principle is that the fixed rate should be such that there are no opportunities for arbitrage. That fixed rate is also known as the price of the swap. The price of a LIBOR zero coupon bond based on LIBOR is 1 divided by 1 plus the LIBOR rate for TI days multiplied into TI divided by 360, where TI days may be 90, 180, 270 or 360 or more days. So this is the price of a zero coupon bond that matures in TI days, where the price is calculated by discounting the par value of the bond at the spot LIBOR for TI days in the market. Now, if we assume a floating rate LIBOR bond that pays coupon, but the coupon is floating, then the price of that bond can be easily calculated as the present value of 1, that is the par value, plus the interest payment that will be based on the LIBOR for that period. Now let's have a look at figure 11.2 to see how this floating rate LIBOR bond is valued at every reset period, that is on day 90, day 180, day 270, and we will be doing it backward. That is what we know as backward integration. So we start valuing the bond at day 270, then at day 180, then at day 90, and then at the present day. The cash flows of a floating rate bond are given here. The floating rate bond makes payment based on LIBOR. So the first payment will be in 90 days based on the LIBOR for 90 days today. The second payment will be in 180 days for 90 days, and that will be based on the LIBOR on day 90. Third payment will be made on day 270, and that will be for 90 days based on the 90-day LIBOR on day 180. And the fourth payment will be on the 360th day, and it will be for 90 days, and that will be based on the LIBOR on day 270. As we will need the spot LIBOR on 90-day borrowing here, here, and here, as well as here, we only have the spot LIBOR rate available on day naught, that is today. We don't know the other three LIBORs as they are spot rates and will only be known on their respective spot dates. However, we don't need them to value the floating rate bond today here. The reason is that we know that on every reset date, the floating rate bond will always be equal to the par value, and the par value of the floating rate bond is 1. On each reset date, the coupon rate is reset to the market LIBOR, and as the coupon rate will be the market rate, that is LIBOR, so the price of the bond should equal the par value of the bond. So it would neither sell at a premium or at a discount, but at the par value. Therefore, for valuation of floating rate bond, we only need the cash flows for the first period, which in our case are the interest payment here plus the value of the bond at the end of the first period, which will be equal to the par value, which will be equal to the present value of all the future cash flows. And we know that at every reset period, this will be equal to the par value of the bond. Now, using the backward integration approach, if we value the floating rate bond on day 270, the price of it should be equal to the present value of the $1 principal plus the interest on the floating rate bond, which will be based on the 90-day spot LIBOR on day 270. So if we calculate the present value of these two cash flows on day 270th, they should be equal to $1. We can write it like this: 1 plus the LIBOR for 270 days multiplied into Q divided by 1 plus the LIBOR for 270 days multiplied into Q, which is the number of days, divided by 360. As the numerator and the denominator are the same, so we cross them and we are left with 1, which is the par value of the floating rate bond equal to the market value of the floating rate bond on day 270. Similarly, the value of the bond on day 180 will be equal to the present value of the cash flows on day 270. In other words, it will be equal to 1. That is 1 plus the interest payment based on the 90-day LIBOR on day 180 in the spot market multiplied into Q, which is the number of days, divided by 360, divided by 1 plus the LIBOR in the spot market for 90 days borrowing on day 180 multiplied into Q, which is the number of days, divided by 360. Again, we cross this and we are left with the value of 1. So this value is the market value of the bond, the floating rate bond, on day 180. Similarly, on day 90, it will be equal to 1 again. The same logic. We have already seen that the value of the bond today will be equal to the present value of the interest payment on day 90 plus the market value of the bond, which we just now have confirmed will be equal to 1. So it will be 1 plus the LIBOR today for 90 days multiplied into Q divided by 1 plus the spot LIBOR today multiplied into Q, which is the number of days divided by 360. Again, this divided by this will give us the current value of the bond equal to 1. Today, the price of this floating rate bond will be equal to 1, and on every reset date, it will be equal to 1. That is, on every reset date, the price of the floating rate bond will be equal to the par value of the bond. In between the two reset dates, that is during the settlement period, the floating rate bond can have a market value or price greater than or less than the par value. But when the reset date arrives, the price of the bond will exactly equal the par value of the bond. Understanding the valuation of floating rate bond is important for pricing a swap. Assume that you have issued a fixed rate bond at $1 par value, and you have to pay a fixed rate interest on it. The $1 par value received from selling the fixed rate bond is invested then in buying a floating rate bond that has a par value of 1. So the floating rate bond and the fixed rate bond have the same value, that is $1. Now, what is the rate at which the fixed rate bond will have all its future cash flows equal to $1, that is the same price as the floating rate bond? If you calculate this rate, that is the fixed rate that you should be paying in a swap where you are the fixed rate payer and receiving the LIBOR. If the price of the fixed rate bond is not equal to the floating rate bond, then there is an opportunity for arbitrage. If the fixed rate bond is selling at a higher price, you will be issuing the bond at the fixed rate and you will be buying the bond at the floating rate. If the fixed rate bond has a value less than the floating rate bond, in that case you will be issuing the floating rate bond and buying the fixed rate bond. Let's have a look at figure 11.3, which has outlined the interest rate swaps cash flow into fixed rate and floating rate payments. Here we have a 1-year swap with payments based on LIBOR quarterly and a fixed rate. The LIBOR for the first 90 days is already known here, so it is L0 here. L90 means this is the spot rate LIBOR on day 90 for payment in the second quarter. The LIBOR on day 180 is used to make the payment on day 270, that is the third quarter, and the LIBOR on day 270 will be used to make the payment on day 360. So if we consider this side of the swap as a floating rate bond and this side of the swap as a fixed rate bond, we can calculate the value of the fixed rate bond here and the value of the floating rate bond here. The value of the floating rate bond here will be equal to $1, that is the par value. The value of the fixed rate bond should also be equal to $1 here. We know the interest payment on the fixed rate bond in advance for all the 4 quarters, and we know that it will also pay the $1 principal. So if we know the spot LIBOR rate for 90 day, 180 day, 270 day and 360 day, we can discount the respective cash flows for each period and then sum them, and they should equal to 1 provided there are no arbitrage opportunities in the market. However, here we will be using 4 separate rates for 4 different cash flows. The question is, at what single rate we can discount all these 4 different cash flows to get them equal to $1, that is the par value of the fixed rate bond which would be exactly equal to the par value of the floating rate bond. If we calculate that rate, that is the fixed rate that should be used in the swap. So instead of using 4 different spot rates for each cash flows on the fixed rate bond, the objective is to use one single fixed rate to discount all these cash flows and get a value equal to the par value of the floating rate bond, that is $1, so that there is no opportunity of arbitrage. This is the value of the fixed rate bond here, which is the sum of the present value of all interest payment and then the present value of the par value. So these are notationally represented here, but we already know that this is the present value of the fixed coupon payment and this is the present value of the par value. If we sum these two should give us the value of the fixed rate bond. Note that the fixed rate here is not equivalent to the yield to maturity. The yield to maturity assumes that all the cash flows on the bond have the same risk and that the yield curve is flat. The fixed rate we calculated accounts for the term structure of interest rates and does not assume that the cash flows are having the same risk. So the cash flow in the first quarter and the cash flow in the second quarter and the third and fourth quarter have different risks, and the term structure of interest rate has accounted for that, which we use to estimate the fixed rate for the bond. As we know, the value of the swap at the start should be equal to 0, and given our analogy, the value of the floating rate bond should be equal to the value of the fixed rate bond. That is, if I write it here, it will be equal to value of the fixed rate bond is equal to the value of the floating rate bond. Now, we know that the value of the fixed rate bond and the value of the floating rate bond both will change as time passes because interest rates in the market will change. So we will see that at time t, that is between time 0 and time 1, what will happen is that the floating rate bond may trade at a value greater than or less than the par value, and that will all depend upon the interest rate prevailing between these two dates, that is at time t. So the interest payment is fixed here for the period. However, during the settlement period, the interest rate may go up or go down. That will cause the floating rate bond value to go up or go down. Similar changes will be observed in the value of the fixed rate bond, which will also fluctuate in value with changes in interest rate. So anytime between time 0 and time 1, if we want to value swap, we just need to calculate the value of the floating rate bond and the value of the fixed rate bond, because we are paying fixed rate and we are receiving floating rate here. So therefore the value of our swap will be the value of our hypothetical asset in which we have invested. In this case it is the floating rate bond, and the value of our hypothetical liability in this case, which is the fixed rate bond. So the difference between these two will be the value of the swap, which can be positive or negative. To estimate the fixed rate in the swap from our hypothetical positions in the two bonds, we need to value the swap at the start. So the value of the swap at the start is always equal to 0. If that is the case, and we know that the value of the floating rate bond will be equal to 1, the value of the fixed rate bond is given by this expression, which is equal to the present value of the interest payment on the fixed rate bond plus the present value of the par value. We know that these both should be equal, so the value of the fixed rate bond should be equal to the value of the floating rate bond. Now if we see this term here, it can be taken to the other side, so it becomes 1 minus the present value of the par value. On this side we are left with the present value of the fixed interest payment. Also note that both R and Q are common factors here, so we can take them out and the expression becomes this one. So now we have RQ as the common factor outside of this expression. If we further manipulate and divide this by taking this term to the other side, we are left with RQ, which is equal to this expression. And if we further manipulate and take Q to the other side, we have 1 over Q, and that multiplies into this whole term. So this gives us the formula for the fixed rate. This is exactly what we have here on the slide. So we now have the formula to estimate the fixed rate, and we know how to derive this. Let's have a look at table 11.2. In this example, we learn to price a plain vanilla interest rate swap for quantum electronics, which is entering into a 20 million notional amount interest rate swap for 2 years and promises to pay fixed and receive floating LIBOR. Payments will be made every 6 months on the assumption of 30 days per month and 360 days a year. The term structure of the LIBOR and the zero coupon bond prices based on that term structure have been calculated in table 11.2. The LIBOR rates for 180, 360, 540 and 720 days are given, and based on these rates, the zero coupon bond prices with par value equal to $1 are calculated. Using the formula here for the fixed rate in a swap, we estimate the fixed rate to be 4.34%. Now make a note of this, that this is 360 divided by 180 and not 1 over Q. You can do 1 over Q here and it will be 1 divided by 0.5, because 180 divided by 360 is equal to 0.5. So either you write it as 1 divided by 180 divided by 360, or you just simply divide 360 divided by 180. Both are fine. Quantum electronics can now use this 4.34%, which is the fixed rate, to estimate the payment on the swap which they have to make, which is the notional value of the swap multiplied into the fixed rate multiplied into days divided by 360. The payments are semi-annual, so it will be 180 divided by 360. So that is equal to $434,000. The swap dealer scored the fixed rate in the swap as fixed rate pair or fixed rate receiver, and the pair rate will be less than the receiver rate, as you can expect they want to make money out of it as they are the market makers or dealers. Swap spread is very important. It is calculated as the swap fixed rate minus the treasury rate. It is considered as a benchmark of credit risk in global economy. The swap fixed rate is estimated from the term structure of LIBOR rates, which are used by banks in London for borrowing from each other. Hence, LIBOR reflects the credit risk in bank borrowing from each other. The treasury rate, on the other hand, is the default risk-free rate of US government. So the difference between the swap fixed rate and the treasury rate is considered as a measure of credit risk in global economy. An increase in the swap spread is indicative of credit risk increasing in global economy, and a decrease in the swap spread is indicative of decrease in the credit risk in global economy. Given the relationship between swap fixed rate and treasury rate and its implication for credit risk, sometimes swap fixed rate is quoted as treasury rate plus swap spread. The valuation of a swap during its life is easy, as we know that we simply have to calculate the value of the fixed rate bond and the value of the floating rate bond and calculate the difference between the two. That is the value of the swap at time t. Now let's have a look at table 11.3 for an example of this. Continuing with our example of quantum electronics, we know that the fixed payments are 4.34% and the LIBOR rate was 3% for the first payment that was to be made in 180 days. Now 90 days later, The term structure of LIBOR for the remaining days is given. 90 days have gone past, so we are left with 90 days till the first payment, 270 days till the second, 450 days till the third, and 630 days till the last payment. The spot LIBOR rates are available for these maturities, and we use these to estimate the prices of the zero coupon bond for respective payment dates, and we have done this here. Now, value the fixed rate bond. What we need to do is to use these zero coupon bond prices and multiply them by the interest rate applicable for that maturity. So we already know that the fixed rate bond had a fixed payment of 4.34%. So 4.34% for 180 days implied that we should be paying 2.17% for the first 6 months. So 2.17% multiplied into the zero coupon bond values will give us the present value of the total coupon payments on the fixed rate bond. And if we add with this the present value of the par value, we will get the total value of the bond, which is equal to 1.00837259. The value of the floating rate bond is equal to the present value of all its cash flows. Its cash flows again are comprising of interest payment plus the par value or the market value at the next reset date, that is after 90 days. So 90 days later, the floating rate bond is going to pay interest at 3%. Adjusted for 180 days, that means 1.5% or 0.015. And the par value is 1 or the market value is 1. That will be the value at the next reset date. So if we multiply these two cash flows, because they are on the same day, that is the next reset date 90 days later, the discount factor or the price of the zero coupon bond for the first payment is 0.9922. So we get 1.00713178 as the value of the floating rate bond. The value of the swap is now easy to calculate as the difference between the value of the floating rate bond and the fixed rate bond. But this is based on $1 par value. We have the notional value of the swap equal to 20 million. So if we multiply this figure here by 20 million, we get the value of the swap negative $24,816. That is the value of the swap for quantum electronics. For the counterparty, the value of the swap will be positive. Somebody's gain is somebody's loss. That is zero-sum game. It is important to value a swap during its life for at least 3 reasons. First, it reflects the economic value of the transaction over time. Second, companies are required to report the market value of their derivative assets and derivative liabilities in financial statements. Third, it also indicates credit risk. In our example, quantum electronics was having no credit risk as the derivative was having a negative value for it. However, the counterparty in the swap was bearing the credit risk in the transaction. A basis swap involves both parties to be paying two different floating rates. For example, a swap involving paying treasury bills rate plus a spread and receiving LIBOR is a basis swap, as both rates are floating. It is quite useful to hedge the interest rate risk of a firm that has borrowing and lending exposures at different rates at the same time that are tied to two different floating rates. Factors affecting the two different floating rates are not the same. Basis swap helps manage the basis risk in such a situation. The cash flows are netted usually in a basis swap. Note that as LIBOR is greater than treasury bills rate, the treasury bills rate will also have a spread added to it to equate both sides of the swaps. A basis swap is equivalent to the difference between two plain vanilla swaps based on different rates. For example, here we have two swaps. The first swap involves paying treasury bills rate, which is the floating rate, and receiving a fixed rate derived from the treasury bill term structure. The second swap involves paying fixed rate, which is derived from the LIBOR term structure, and receiving LIBOR, which is the floating rate. Combinedly, these two swaps are equal to one basis swap involving two floating rates. So one party pays the treasury bills rate and receives the LIBOR, but also pays the spread, which is equal to the difference between the LIBOR and the treasury bill fixed rate. Alternatively, the counterparty may agree to receive the treasury bill rate and pay LIBOR less the spread, which is the difference between LIBOR and the treasury bill fixed rate. Table 11.4 and Table 11.5 have examples of pricing and valuation of a basis swap. Let's have a look at them. This basis swap has 1 year term and it involves semi-annual payments. According to the terms of the swap, the party is required to pay the treasury bill rate and receive LIBOR minus a spread, and payments will be made based on days divided by 360, and there will be 30 days in a month. The notional amount in the swap is 50 million, and the term structure of interest rates for both the LIBOR and the treasury bill rate are given. Using these rates, we calculate the prices of zero coupon bonds for the given maturities, and then we calculate the fixed rate from the LIBOR term structure and also the fixed rate from treasury bill rate term structure. So the LIBOR fixed rate is 7.09% and the treasury bill fixed rate is 6.21%. To calculate the spread, we simply deduct the treasury bill fixed rate from the LIBOR fixed rate, and it gives us 0.0088, and that is equal to 88 basis points. In this case, the party that is expected to pay the treasury bills rate would be required to pay 88 basis points more. Alternatively, the party that pays LIBOR would be paying 88 basis points less than the LIBOR. Table 11.5 illustrates the valuation of the same basis swap after 90 days into its life. Using the term structure for LIBOR and the treasury bill rate given here, the zero coupon bond prices have been calculated for the respective maturities. Again, we have to value bond. However, this time both the bonds are floating rate bonds, as the basis swap involves two floating rates. One is the treasury bills rate and the other is the LIBOR rate. Now, we are assuming that there are two parties, party A and party B. Party A is paying the treasury bills rate and party B is paying the LIBOR, and we are assuming that the party paying the LIBOR will pay 88 basis points less than the LIBOR. So from the previous slide, we know that the party paying the fixed T-bill rate will have to make a payment at 5.05% for the first 180 days, and this party here will have to pay 7.01% minus 0.88%, that is 6.13% in the first 6 months. First, we value the floating rate bond for the party that is required to pay the treasury bills rate. On the reset date, that is 90 days from now, the floating rate bond will have a par value of 1, as it will be the reset date. Plus, there will be an interest payment of 5.05% for the 180 days. So the present value of these two cash flows, given the discount factor or the price of the zero coupon bond for the 90 days, is 1.0117167. In the same way, we estimate the value of the floating rate bond for the party that is required to pay LIBOR minus the 88 basis points, and the value of the floating rate bond in such a case is 1.0124075. Now, to value the swap from the perspective of the party that is paying the treasury bills rate and receiving LIBOR less 88 basis points, for a notional value of $1, it will be the difference between the prices of the two bonds. because this party is receiving the LIBOR rate, so it is an asset for it, and it is paying the treasury bills rate, so this is a liability for it. The difference between these two bonds value is actually the value of the swap for this party that is paying the fixed T-bill rate and receiving the LIBOR adjusted for the 88 basis points. Multiplying this value by the notional value of the swap gives us the value of the swap contract, which is 34,540 in this case. The most common application of an interest rate swap is to convert a floating rate loan into a fixed rate loan, or a fixed rate loan into a floating rate loan. Here in figure 11.4 we have an example of converting a floating rate loan into a fixed rate loan. Let's have a look at it. XYZ here is a borrower that has borrowed at LIBOR plus 1% from the lender. It expects interest rates to rise, which will increase its borrowing cost. Therefore, it enters into a swap with the counterparty here and agrees to pay 7.5% fixed and receive LIBOR. It is receiving LIBOR here and it is paying LIBOR here. These two payments will cross, and the net payments that XYZ is paying after the swap is 7.5% plus 1%, that is 8.5%. So effectively the interest rate swap has enabled XYZ to convert its LIBOR floating rate loan into a fixed rate loan at 8.5%. Interest rate swaps can also be used for speculation. In the example, we learned that the spread between the two rates was 88 basis points. If this spread is expected to narrow or widen, speculative positions can be established to take advantage on the basis of these expectations. There are three other types of interest rate swaps that we briefly discuss here. These are index amortizing swaps, DIF swaps, and constant maturity swaps. Index amortizing swaps have notional principal that reduces over time and are typically used by financial institutions to manage the interest rate risk associated with their mortgage portfolios or other amortizing loans. Homeowners can prepay or retire their loans early if interest rates fall. Therefore, the notional value of such a swap declines according to a set schedule with specified acceleration rates to account for such prepayments. DIF swaps involve interest rates in two countries. However, payments are made in one currency. For example, a UK firm that borrows in dollars will face the risk of a rise in dollar interest rates. It may enter into a DIF swap paying UK interest rate and receiving dollar interest rate. If the US interest rates rise, it will receive a net payment from the dealer in pounds. The dealer runs the currency risk, which will be passed on to the clients in hedging cost. A constant maturity swap involves paying or receiving a floating rate such as LIBOR versus receiving or paying another floating rate tied to a security with maturity longer than the reset period. Typically, the rate with the longer maturity is the rate on a treasury security with a 2 to 5 years maturity. The rate on the longer maturity is known as CMT rate, that is the constant maturity rate. The Federal Reserve issues the estimate of the CMT rate. As both rates in this swap are floating, it is also known as a variation of the basis swap. Like the basis swap, it also requires a spread to be paid if LIBOR is greater than the CMT rate. Also, if one party is paying the CMT rate and the other party is paying a fixed rate, then it becomes a variation of the plain vanilla swap.